Your inflation hedge just experienced the most violent price swing in 4 decades. Between January 22 and January 30th, 2026, silver traveled from an intraday high of $34.87 per ounce to an intraday low of $28.14, a 6.73 range, representing 19.3% peak-to-trough volatility in just 6 trading sessions. Gold moved from 2,190 to 2,711 over the same period, a 6.4% range. For context, the average 6-session trading range for silver over the past 5 years is 3.2%. The current move is 503% larger than the historical norm. This is not normal correction following extended rally. This is structural breakdown in price discovery, where fundamental value anchors dissolve and positioning dynamics dominate. The last time silver experienced comparable 6-day volatility was March 2020, when COVID lockdowns triggered simultaneous margin calls across all risk assets. Before that, you have to return to September 2011, when silver was unwinding from the speculative blow-off top at $48.70. Both episodes preceded sustained bear markets lasting years. The wealth has already been transferred. The positions have already been liquidated. The narratives have already been shattered. What remains is understanding what this volatility reveals about the structure beneath precious metals markets, and what it signals about the stability of the monetary system those metals are supposed to hedge against. I'm John A.G., and this is the Collapse Files. What just happened? On January 22, 2026, silver reached an intraday high of $34.87 during Asian trading hours, the highest level since May 2013. When the metal briefly touched $35.12 before collapsing 33% over the subsequent 8 weeks. The January 22nd peak represented a 23.4% rally from the December 2025 low of 28.26, driven by narratives of industrial demand growth, central bank gold accumulation creating spillover silver buying, and gold to silver ratio reversion from 88.1 toward historical averages near 65.1. Within 48 hours, by the London PM fix on January 24th, silver had declined to 32.41, a 7.1% drop from peak. The selling accelerated between January 27th and January 29th, as Scott Bessent's nomination as Federal Reserve Chairman triggered coordinated liquidation across precious metals. By January 29th at 3:21 p.m. Eastern, silver reached $29.28, down 16.0% from the January 20th peak. The final leg lower occurred on January 30th during a liquid overnight trading. Between 2 a.m. and 4:30 a.m. Eastern, silver declined from $29.51 to an intraday low of $28.14, a 4.6% decline in 150 minutes of thin trading, characterized by wide bid-ask spreads and absent market makers. The move was driven by stop-loss cascades as algorithmic systems automatically sold when technical support levels at $29.50 and $29 were breached. By market close on January 30th, silver had recovered to $29.03, still down 16.8% from the January 22nd high. The 6-session round trip from $34.87 to $28.14 and partial recovery to $29.03 created a realized volatility of 19.3% peak to trough, the highest 6-day volatility since the March 1825-2020 period, when silver ranged from $16.21 to $12.01, a 25.9% swing. Gold followed a similar but less extreme pattern. The metal peaked at $2,190 on January 22nd during European trading, representing a 5.3% rally from the January 2nd level of $2,750. By January 29th at 3:21 p.m., gold had declined to $2,631, down 5.7% from peak. The overnight session on January 30th saw gold reach an intraday low of $2,611 at 3:45 a.m. Eastern before recovering to close at $2,647. The gold-to-silver ratio, the number of silver ounces required to purchase 1 ounce of gold, fluctuated violently across this period. At the January 22nd peaks with gold at $2,790 and silver at $34.87, the ratio stood at 80.0, the lowest level since April 2021. By January 30th, with gold at $2,611 and silver at $28.14, the ratio had spiked to 92.8, a 16.0% widening in 6 sessions. This ratio expansion indicates silver weakened significantly more than gold, consistent with silver's higher beta to risk-off sentiment and its dual exposure to both monetary conditions and industrial demand expectations. What makes this move abnormal is the absence of proportional fundamental catalysts. Industrial silver demand data released during this period showed modest growth. Global solar panel installations in 2025 increased 8.2% year over year according to preliminary estimates, while semiconductor sales growth moderated to 4.1% but remained positive. There was no collapse in industrial consumption to justify 16.8% price declines. Mine supply data showed no surge in production. In fact, several major producers reported lower Q4 2025 output due to declining ore grades at aging mines. The move was driven almost entirely by financial market positioning adjustments. Profit taking by momentum traders who had ridden the rally from $28 to $35, forced liquidation by leveraged longs who received margin calls as prices declined, algorithmic stop-loss selling that accelerated once key technical levels broke, and broad-based precious metals selling following the Bessent Fed chair nomination. These are technical and positioning factors, not fundamental industrial supply-demand factors. The speed and magnitude reveal that recent price strength was built on fragile foundations of leverage and momentum rather than durable accumulation by long-term holders. When those foundations cracked, the reversal was swift and brutal. Precious metals markets are designed to provide price discovery through the interaction of three participant classes: industrial consumers who purchase metal for manufacturing, investors who allocate capital for wealth preservation or speculation, and producers who extract and refine metal for sale. In a well-functioning market, these participants provide counterbalancing forces that dampen volatility. When industrial demand weakens, investors accumulate at lower prices, establishing a floor. When speculative buying drives prices above production costs, miners increase output, capping rallies. The system relies on continuous liquidity provision by market makers, financial institutions that stand ready to buy when others are selling and sell when others are buying, profiting from bid-ask spreads rather than directional bets. Market makers absorb temporary order imbalances and smooth price discovery, preventing small shifts in supply or demand from generating disproportionate price moves. The system functions when participant flows are diversified and uncorrelated. A given day might see industrial buying offset by producer hedging, with investors providing marginal demand and market makers facilitating all transactions at tight spreads. Prices adjust gradually as genuine information about supply constraints or demand growth is incorporated. The system fails when participant flows become correlated and one-directional. If investors, industrial consumers, and producers all attempt to sell simultaneously, market makers cannot absorb the volume without taking losses that exceed their risk limits. They withdraw liquidity, bid-ask spreads widen dramatically, and prices gap down to levels where new buyers finally emerge. The January 22nd to 30 period exhibited exactly this dynamic. The breakdown sequence began with profit-taking by momentum traders who had purchased silver in the 29.31 range in early January, expecting continuation of the rally. When prices stalled at 34.87 and began declining, these traders sold a lock in profits. The selling pushed prices below $33, which triggered stop-loss orders placed by leveraged traders who had purchased using margin. Those stop losses generated automatic selling regardless of fundamental outlook, driving prices to $32, then $31. As prices declined through psychological support levels, industrial consumers who had been waiting to lock in forward purchases at lower prices remained absent, betting that further declines were coming. Simultaneously, miners who had hedged production at 32 to 34 saw those hedges become profitable and chose to maintain them rather than close out positions. The absence of industrial buying combined with continued financial selling created one-directional flow. Market makers, observing the breakdown in normal order flow correlations and facing mounting losses on inventory purchased at higher prices, reduced position limits and widened bid-ask spreads. Spreads that normally run 5 cents per ounce in silver widened at 28 to 42 cents during the January 30th overnight session, making execution costs prohibitive for all but the most desperate sellers. The trapped participants were leveraged long investors who purchased silver futures using 15.1 or higher leverage at prices between $32 to $35. A 10% decline from $34 to $30.60 would exhaust the equity cushion for anyone using more than 10.1 leverage, triggering forced liquidation. As prices cascaded below $30, then $29, wave after wave of leveraged positions were liquidated automatically by brokerage risk management systems. Also trapped were options. Traders who had sold put options at strike prices of $30 and $31, collecting premium under the assumption that silver would remain above those levels. As spot prices approached and then breached those strikes, these traders faced unlimited downside exposure and rushed to hedge by selling futures, adding to downward pressure. Finally, retail investors who purchased physical silver coins and bars at $33.35 based on YouTube videos and social media narratives about monetary debasement found themselves holding assets that had declined 15-20% within days. Unlike futures traders, they faced no margin calls and could not be forced to sell, but the psychological damage was severe. Many had allocated disproportionate percentages of savings to silver based on conviction that prices could only rise. Seeing rapid declines shattered confidence and created risk that further weakness would trigger panic selling of physical holdings. The reflexive loop continues until forced liquidation exhausts and physical buyers recognize value. That floor appears to have been established near $28, approximately $2 above most primary producers' all-in sustaining costs. At those levels, miners would curtail production if prices remained depressed, and long-term physical accumulation becomes compelling to investors with multi-year time horizons. The 673 peak-to-trough range in silver from 34.87 to 28.14 represents 19.3% of the peak price. Breaking this into constituent moves, the initial decline from 34.87 to 32.41, January 26 to 24, was 2.46 or 7.1%, driven by profit taking. The second leg from 32.41 to 29.28, January 24-29 was 3.13 or 9.7%, driven by Bessent nomination and forced liquidation. The final overnight cascade from $29.51 to 28.14, January 30th, was 137 or 4.6%, driven by stop-loss algorithmic selling in illiquid conditions. Analyzing each leg by volume. COMEX, silver futures. Volume during the January 22-24 decline averaged 124,000 contracts per day, compared to a 2025 average of 87,000 contracts, a 43% increase indicating elevated but not extreme selling. During the January 27-29 period, volume surged to an average of 198,000 contracts per day, a 128% increase over baseline, consistent with forced liquidation. The January 30th overnight session volume was only 34,000 contracts due to the timing outside regular U.S. hours, but this light volume in the presence of a 4.6% decline confirms market maker withdrawal and liquidity vacuum. Examining the gold to silver ratio dynamics, at the January 22nd low of 80.0, the ratio was pricing silver at relative strength last seen in April 2021 when silver briefly traded at 29.85. The subsequent expansion to 92.8 by January 30th represents a 16.0% widening. For context, the 20-year average gold to silver ratio is 68.02. The current 92.8 ratio is 36% above that long-term average, suggesting either silver is undervalued relative to gold, or structural factors have shifted that make the historical average relationship irrelevant. Calculating implied volatility changes. Silver 1 month at the money implied volatility, as reflected in COMEX silver options pricing, surged from 24.8% on January 2010 to 41.7% on January 30th, a 72% increase in implied volatility. This means options markets are pricing a 1 standard deviation move of $12 weight per ounce over the next 30 days, 41.7% of the $29.03 close. For comparison, during the stable period of July-November 2025, 1 month implied volatility averaged 18.2%, pricing in monthly standard deviation moves of just $5.46. The realized volatility calculation confirms the options market pricing is justified. The 6-day realized volatility from January 22nd and 30, annualized using the square root of time rule, equals 78.4%, nearly double the implied volatility, indicating the actual price moves exceeded what options markets had priced in. This creates opportunity for volatility sellers who can correctly time entry, but also demonstrates the inadequacy of historical volatility models in predicting crisis episodes. ETF flow data provides insight into investor behavior. The iShares Silver Trust, SLV, saw net outflows of 14.3 million ounces between January 22 and January 30th, according to preliminary data, a 2.5% decline in assets under management. For comparison, during the entire month of December 2025, SLV saw inflows of 8.7 million ounces. The January reversal represents a complete unwinding of December accumulation, plus an additional 5.6 million ounces, indicating not just profit-taking but active risk reduction by institutional holders. Breaking down the price distribution of the 6.73 total range, 36.5%, 246, occurred during relatively orderly profit-taking, 46.5%, 313, occurred during forced liquidation following a specific catalyst, Bessent nomination, and 17.0%, 114, occurred during illiquid overnight technical breakdown. This distribution suggests the majority of the move was driven by identifiable positioning unwinding rather than fundamental reassessment. Examining cross-asset correlations. During the January 22-30 period, the correlation between silver and the S&P 500 was plus 0.34, compared to a 2025 average of plus 0.12. This increased correlation indicates silver was trading more as a risk asset, declining when equities decline, than as an inflation hedge or safe haven. Simultaneously, silver's correlation with the US dollar index was 0.68 compared to a 2025 average of 0.41, indicating heightened sensitivity to dollar strength as Bessent's nomination drove expectations of sustained dollar appreciation. Finally, examining the bid-ask spread expansion quantitatively, during normal trading on January 22nd, the average bid-ask spread in COMEX silver futures was 0.04 per ounce, or 0.011% of spot price. During the January 30th overnight session, spreads widened to an average of 0.35 per ounce, or 1.21% of spot price, a 109-fold increase in transaction costs. For an institutional trader executing a 1,000 contract position, 5 million ounces, this spread expansion added $1.55 million in hidden costs versus normal conditions. Historical precedents. The most comparable precedent is the April-May 2011 silver volatility episode. Silver peaked at $48.70 on April 28, 2011, driven by post-financial crisis inflation fears and retail investor momentum. Within 3 weeks, by May 12, 2011, it had declined to $32.86, a 32.5% peak-to-trough move. The catalyst was a series of 5 COMEX margin requirement increases between April 25 and May 5th. The subsequent volatility was extreme. Between May 12th and September 26, 2011, silver ranged from $32.86 to $48.18, briefly recovering, to $26.15, a $22.03 range, or 67% of the peak price over 137 days. The realized annualized volatility during this period exceeded 85%, making silver one of the most volatile major assets globally. The episode destroyed confidence in silver as a stable store of value and preceded a 4-year bear market that saw prices ultimately reach $13.71 by December 2015. The lesson from 2011: once volatility reaches extreme levels and forced liquidation purges leveraged participants, the recovery is not automatic. Silver spent years rebuilding a base, requiring new narratives and new capital to eventually return to previous highs. Those who purchased at $45.48 in April 2011 did not see break-even prices again until July 2020, a 9-year wait. The second precedent is the March 2020 COVID crash. Between March 9 and March 18, 2020, silver declined from $17.36 to $12.01, a 30.8% drop in 7 trading days as liquidity evaporated across all markets. The gold to silver ratio spiked to 125.5, the widest level in modern history, as gold rallied on safe haven demand while silver was dumped due to industrial demand collapse fears and broad deleveraging. The March 2020 episode exhibited several features identical to January 2026. Illiquid overnight sessions with extreme price gaps, bid-ask spreads widening to 50+ cents per ounce, massive ETF outflows as institutions redeemed shares, and forced liquidation overwhelming any fundamental buyers. The recovery was swift. Silver rallied from $12.01 on March 18th to $18.92 by July 31st, 2020, a 58% gain in 135 days. But this recovery was driven entirely by unprecedented Federal Reserve intervention, including $120 billion per month in asset purchases and rates cut to zero. Critically, the March 2020 recovery was possible because the Fed could credibly intervene at unlimited scale. The current environment in early 2026 differs. With the Bessent nomination signaling potential return to monetary discipline, the playbook of automatic Fed rescue may no longer be operative. If silver experiences March 2020 magnitude volatility without the certainty of Fed intervention, the recovery timeline could be much longer. A third case is the 1980-1982 collapse following the Hunt brothers manipulation. Silver peaked at $49.45 on January 18, 1980, then crashed to $10.80 by June 1982, a 78% decline over 29 months. The volatility during the unwinding was extraordinary, with multiple 10% plus single-day moves. The realized 60-day volatility reached 147% annualized in March 1980. The collapse was driven by regulatory intervention, Silver Rule 7 prohibiting new long positions, margin calls that forced liquidation of the Hunt brothers' leveraged positions, and complete destruction of confidence in silver as a stable value store. The 1980-1982 parallel is relevant not because current conditions involve manipulation on the Hunt scale, but because it demonstrates that silver volatility, once unleashed, can persist for years and generate cumulative declines that destroy generational wealth. The pattern is consistent: leverage, plus narrative-driven speculation, plus illiquid markets, explosive volatility that overshoots in both directions and leaves destruction in its wake. The mainstream narrative interprets the January 22-30 volatility as a healthy correction following an overbought rally, with subsequent stabilization near $29, suggesting a new base formation. This narrative misses the structural message embedded in the volatility itself. The silver market has become dominated by financial speculation to such a degree that price discovery has broken down, and industrial fundamentals are irrelevant to short-term pricing. And what most people miss is that extreme volatility is itself a signal of system fragility independent of price direction. A market that can decline 16.8% in 6 sessions can also rally 20% in 6 sessions on minimal fundamental news. This bidirectional volatility makes silver unsuitable for its primary intended function, a stable store of value and hedge against currency debasement. If your hedge experiences greater volatility than the risk you are hedging against, it is not a hedge, it is additional risk. The second thing most people miss is the narrative destruction embedded in the volatility. Silver bulls have argued for years that industrial demand deficits, consumption exceeding production, create structural price support. Yet silver declined 16.8% in 6 days despite no change to those structural deficits. This proves that financial positioning can overwhelm industrial fundamentals for extended periods. Bulls who invested based on deficit narratives discovered those narratives provide no protection against leveraged liquidation cascades. The third overlooked factor is the role of declining liquidity in amplifying volatility. Market makers in precious metals have faced compressed profit margins for years due to intense competition and regulatory capital requirements post-2008. Many have reduced precious metals market making to minimal staffing and capital allocation, treating it as a legacy business rather than strategic focus. When volatility spikes, these firms have limited capacity to absorb order flow, so they withdraw entirely. The January 30th overnight spread widening to 35 cents occurred not because of overwhelming selling volume, only 34,000 contracts traded, but because no market makers were willing to provide liquidity at any tighter spread. This liquidity fragility creates a doom loop. Volatility causes market maker withdrawal, which causes wider spreads and worse execution, which causes more volatility as participants rush to exit before conditions deteriorate further. The loop continues until price reaches levels where long-term physical buyers overwhelm the selling pressure with scale purchases. But there is no guarantee where that level sits. It could be $20 or 22s or 16s. Market structure provides no floor. The fourth thing most people miss is the political economy implication. Extreme precious metals volatility undermines the narrative that gold and silver provide alternatives to fiat currencies. If silver can decline 16.8% in 6 days, while the US dollar purchasing power declines perhaps 0.2% over the same period, based on CPI, then silver is 84 times more volatile than the dollar it supposedly hedges against. This makes silver look like speculation, not savings, which undermines political support for broader precious metals ownership. Central banks and governments quietly benefit from this volatility because it discourages citizens from fleeing fiat currencies into metals. The more volatile and unreliable precious metals appear, the more acceptable fiat currency debasement becomes. This creates perverse incentives where authorities benefit from destabilizing precious metals markets through policy uncertainty and regulatory ambiguity that enables leveraged speculation and forced liquidation episodes. Finally, most people miss the temporal dimension. Even if silver's long-term fundamentals are bullish due to solar demand and mine supply constraints, long-term could mean 5 to 10 years. Investors who allocated to silver in January 2026, expecting steady appreciation, discovered that short-term volatility can destroy portfolios long before long-term fundamentals play out. The market can remain irrational, or more precisely, dominated by positioning rather than fundamentals, far longer than leveraged participants can remain solvent. The January 22nd 30 precious metals. Volatility signals that commodity markets have become structurally unstable due to the combination of declining industrial participant hedging, increasing speculative financial participation, reduced market maker capacity, and persistent leverage in a low liquidity environment. These conditions create vulnerability to violent price swings that overwhelm any fundamental anchors and make long-term value irrelevant to short-term survival. When volatility reaches 19.3% over 6 sessions in a market supposedly functioning as a stable store of value, it reveals the market is not functioning as designed. It is functioning as a casino where leveraged speculators make directional bets and market structure ensures those bets are periodically liquidated in violent fashion. Those who survive are not those with the best fundamental analysis, but those with the most conservative leverage and longest time horizons. The first thing that breaks when precious metals volatility reaches extreme levels is retail investor confidence. An individual who allocates 10 on 15% of savings to silver at $33 expecting stable wealth preservation, then watches that position decline to $28 in 6 days, loses faith not just in silver, but in the entire concept of alternative assets. This confidence destruction takes years to repair and causes lasting shifts away from self-directed savings toward professional management or simply holding cash, despite inflation erosion. The second thing that breaks is the credibility of precious metals, advocates and influencers. Social media and YouTube are filled with permabulls who have promoted silver accumulation based on monetary debasement, industrial deficits, and manipulation theories. When their followers suffer 15-20% losses in days, those influencers lose credibility. Many will never recover their audiences. This creates information voids, where the next generation of potential precious metals investors lack trusted sources and simply avoid the entire sector. The third thing that breaks is the linkage between precious metals and inflation hedging. If silver declines 16.8% while CPI shows 2.7% annual inflation, the empirical evidence suggests silver is failing at its core function. Rational actors observing this conclude that inflation hedging should be achieved through TIPS, real estate, or equities, not through commodities with 80% annualized volatility. This breaks the theoretical foundation supporting precious metals ownership. The broader implication is that extreme volatility in assets supposed to provide monetary stability reveals instability in the underlying monetary system. Healthy monetary systems produce stable inflation hedges. Gold barely moved during most of the 20th century when Bretton Woods fixed exchange rates provided certainty. The fact that gold and silver now experience 15-20% monthly swings suggests the monetary system itself has become unmoored from stable anchors, creating conditions where nothing provides reliable protection. What breaks first when this realization spreads is the assumption that diversification across asset classes provides safety. If precious metals, supposed safe havens, experience 80% volatility, bonds face duration risk from rate uncertainty, equities trade at 23x earnings dependent on perpetual accommodation, and cash faces debasement risk, then there's nowhere to hide. This creates paralysis, where capital sits in money markets earning negative real returns rather than being deployed productively, which reduces investment, growth, and living standards economy-wide. The January 22nd 30 period saw silver travel from $34.87 to $28.14, a 19.3% range in 6 trading sessions, driven not by fundamental industrial supply-demand changes, but by financial positioning dynamics, forced liquidation of leverage longs, and structural market maker withdrawal during stress. Gold experienced parallel 6.4% volatility. These moves reveal that precious metals markets no longer function primarily as inflation hedges or stable stores of value. They function as leveraged speculation vehicles subject to violent positioning unwinds. This volatility was not random. It was mechanically necessary to liquidate participants who had used excessive leverage to amplify positions built on narratives of inevitable appreciation. When narratives break, as the Bessent nomination broke the narrative of perpetual monetary accommodation, the leverage unwinds through forced selling regardless of long-term fundamental merit. The participants who suffered the greatest damage were those who conflated conviction about long-term trends, monetary debasement, industrial deficits, dollar decline, with permission to use maximum leverage and concentration. The participants who survived or profited were those who understood that even correct long-term analysis provides no protection against short-term volatility when positioning becomes extreme. What the 6-day volatility episode documents is that precious metals prices are determined by the weakest hands holding the largest leverage positions, not by the strongest fundamentals or most patient capital. When those weak hands are forced to liquidate, prices gap to levels that clear all fragile positioning before stabilizing. The fundamental value is irrelevant to this clearing process. Whether silver stabilizes near 29s and eventually recovers toward $35-40 based on industrial demand fundamentals, or whether this marks the beginning of a multi-year bear market back toward $20-22, depends on factors that have nothing to do with the January volatility itself. It depends on whether the Bessent Fed follows through on hawkish policy, whether industrial demand continues growing, whether new leverage accumulates to restart the cycle. What we know with certainty is that the structural conditions that generated 19.3% 6-day volatility remain in place. Declining liquidity provision, increasing financial speculation relative to industrial participation, persistent leverage availability, and policy uncertainty. These conditions make future volatility episodes not just possible but probable. This is the collapse files. The volatility has already occurred. The wealth has already been destroyed. What remains is recognizing that stability in asset prices depends on stability in the systems those assets are meant to hedge against. When both the asset and the system become unstable simultaneously, there is nowhere left to hide except understanding. And understanding provides no returns, only clarity about what has already been lost.